Hey, how you doing everybody? Richard back again with a video I promised about how to buy stocks. First, I want to talk just a little bit about a story that I heard from Tony Robbins once. And Tony Robbins was in New York. He's thinking about buying an apartment overlooking Central Park for about $10 million. He's walking down the road and he sees a guy sitting on the side of the road, looks homeless. He says, "Hey, what can I do for you? I want to give you something," feeling he's in a charitable mood. The guy says, "Well, I just want a cigarette." Tony says, "Well, I don't smoke. Would you like $5 for a pack?" He says, "No, thanks. Just want a cigarette." To make a long story short, he walks away. He says, "What's the difference between me and this guy on the side of the road? I want $10 million for my new house. This guy's happy with a cigarette." And after it's all boiled down and the story's over, what he gets to, and he's absolutely correct, is life will give you whatever you demand from it. So why I bring this up in relation to stocks and your life, things that are good with stocks you can transfer out to the real world, I want you to make that step from hopes, wishes, and dreams to demanding that you're going to be successful in the stock market, and it will happen. That guy's going to get his cigarette just like he wants. Tony Robbins ultimately got his $10 million and bought his house because that's what they're demanding out of life. Now, we'll move on to buying stocks. In case you haven't noticed, everything I do, everything I'm trying to teach you is about how to lose as little as possible. You don't hear me talking about we're going to go in and buy 10 call option contracts and hit it big, or we're trying to make a lot a little of the time. We're trying to make a little virtually all the time, and our umbrella philosophy, once again, transfers out of the market, is to lose as little as possible. My refrigerator's full because I lose less money on electricity. I put on cruise control in my car, I lose less money in gasoline. Okay, it's not just stocks. But I want you to try to notice that, if you haven't already, that the way we do really well in the stock market is by doing it the way we're supposed to. Fortune favors the prepared and the brave. It doesn't favor the haphazard. It doesn't favor you when you cross that line into stupid. It doesn't favor people who need luck. That's, one of the ironies in life is that the people who get the luckiest are the people that need it the least. It's the race car team that oiled everything perfectly, has it all tuned up, has everything tightened perfectly. They checked it 10 times. They're the ones that get lucky. The guys who just threw the race car on the track and the driver in the seat, let's go, they're not going to get lucky. Fortune hates those kind of people. If you're depending on luck, if you're just throwing money at the market, depending on luck, Fortune hates people like that. Okay? So, what's the first step to figuring out what kind of offer you want to make on this business you're buying in the stock market? The first thing to remember is that it's not like buying Joe's Pizza Parlor at the mall. No pizza parlor at the mall would try to charge 1,000 years revenue to sell you that business. That's what Zoom is currently charging to buy its stock. And at the same time, there's no business in the world that would accept an offer of half of book value, which is what banks sold for not all that long ago, which means you take all their junk, you put it on the street and sell it at flea market prices. That's book value. No business is going to take half of that, and no business is going to try to charge 1,000 times revenue. That's the market. It swings to these ridiculous prices, and you have to remember that when you're trying to put in your low ball offer. Is it really a low ball offer, or is it just a pretty good price, making it not a very good price at all? But what we look at is the big picture. How's the macro economy doing? Is the world awash in money? Is are the trade agreements going well? Is the world working cohesively and well, or is it not? If it is, it's probably a seller's market, not a buyer's market, right? You want to look at this kind of the same way. A good analogy is going to buy a house. If you buy a house, you're going to look at what similar houses sold for in the neighborhood, how long houses are on the market, whether you're the buyer or the seller. That's what you look at. If all the other similar houses sold for $1 million, you're going to have to pony up your bid at $950. They're not going to accept 700 grand just because you think that's what the house is worth. And the same thing with stocks. It doesn't matter what you think. This, I'm going to calculate the intrinsic value and make my bid that way. That is such a load of nonsense. It doesn't work for Warren Buffett, Charles Icahn, Ackman, nobody, because you cannot figure that out. You can't figure out in 6 months what's going to happen between now and then to destroy the brand name. They're all friends with Jeffrey Epstein, or the pizza parlor turns into some Pizzagate nonsense, destroys the name brand. There's COVID viruses that come along for the big picture, right? So all you can really do is determine what is the stock worth, what is the house worth in similar situations with similar houses in the neighborhood, sort of thing, right? So we're going to zero it down from the big picture economy. Perhaps, I want to mention, you don't have to have my kind of stocks. Maybe you like Home Depot and Lowe's. They're ubiquitous. They fit my criteria, just not stocks I own. They're ubiquitous, leaders in their field, new all-time highs. So then you'd want to look at their region. America. Is America awash in money? Is America not awash in money? How is the region doing? Then how's the sector doing? How's the home rebuilding sector doing? Is that good? Then you look at the specific business. So you narrow it all down, and I'd like to use a really bad famous trade. When all this COVID virus stuff started, Financial Education put $30,000 into the airlines, dropped like a rock, lost some 85% up until now, or somewhere abouts. So he missed all those things. He didn't look at the world economy. He didn't look at the regional economy. He didn't look at the sector. He didn't look at any of that stuff. He just threw money at the market, which is why you're going to get 6 or 8% returns over 12 years. 12 years of running a channel on YouTube, buying stocks, and he still doesn't understand how to buy them. But that's not even the biggest problem. The biggest problem is you should never go all in with your first buy. You should split it up. I'm going to recommend to you folks, you split it up into 3 tranches. So let's imagine he split it up into 3 $10,000 allotments. Any way you slice it, he'd have been better off. If he'd have bought 10,000 and it fell off a cliff like it did, he might have backed out and said, I'm not putting 20 more in that. Even though my original idea was to put 30 grand, I don't think this is such a good idea anymore. Maybe to put 10 in and only lost 50% of 10 grand down to the next 10 instead of 50% of 30, then maybe he's losing 20 to the bottom and then put in 10 at the bottom, right? You can see how it'd be much, much better. The reason people don't do that is for fear of missing out. Okay, they're afraid, okay, it's at the low, this is great, it's going to go up and I'll miss out if I don't put all my money in now. That is the biggest mistake, is the fear of missing out. The second biggest mistake is overbuying. What's the best way to lose as little as possible on your first buy? Make it small. I don't care if it gets cut in half, at least a small amount is cut in half, not a big amount, right? So you can see how it all goes in to figuring out the stock, going in with these tranches. And what do we use to determine, and the reason I'm making the video today is because it's important, what we use to determine whether the stock is expensive or cheap in relation to itself is the RSI. That's the relative strength index. It's relative to itself. So the reason I'm bringing it up, the reason I'm making this video today, is you've probably seen videos leading up to today, which is Thursday, that the market is just crazy expensive, the stocks are going to crash in June and all that kind of stuff. The RSI, 70 is starting to be too expensive, 30 is starting to be a good deal. The way this particular pseudoscience indicator works, all indicators are pseudoscience. You want to use the facts and the evidence of the big picture, not the pseudoscience, okay? When the facts and the evidence tell you the earth is round and the pseudoscience says it's flat, go with the facts and evidence. And there are plenty of flat earth mentality people, professionals, famous people on TV and on YouTube. Go with the big picture facts and evidence, then look at the RSI. The reason I mention that is the RSI amongst the averages just touched 20 yesterday. So you can watch and see, okay, what happens when you get to that level where virtually everybody who puts a little work into the stock market knows that the market is now too expensive. Well, what happens is all the people that don't know are rushing in with that fear of missing out trade, which is a very small amount of money. So it's going to kind of stall out a little bit at best, or it's going to get pushed up even higher by lots of individuals with small amounts of money, not several of the 10% people that own 85% of the market, or JP Morgan, or Citibank. Those kind of people are not going in whole hog. They know it's too expensive. They know it's going to drop. And the reason it drops quickly is because once those people run out of money, and they don't have a lot of it, so it's fairly quick, there are no buyers anymore. It doesn't take more sellers, another common misconception, it doesn't take more buyers than sellers. If there are no buyers, the market drops off a cliff too, or drops to some extent, not necessarily off a cliff. So, so we look at the RSI to determine how much we're going to pay. I'm not suggesting that you would not buy unless the RSI is down to 30. I'm just suggesting that's how you're going to determine what sort of offer you're going to make to the market. There are very rare times where you might buy over 70. But like I said, it's a pseudoscience indicator. It was designed so if you bought at 30, sold at 70, and you consistently did that, you would make more than the market. That doesn't work. It's not true. But we can use these indicators as we go along. I'll show more of them to you and how we're going to change them around to be much more effective. Make yourself a rule. You're not going to buy stocks over 70. Doesn't mean you have to sell your stocks. They're long-term investments. Sure, they're going to get too expensive, go back down, go back up. You don't have to sell them, but don't buy things that are too expensive. That doesn't fit with our umbrella philosophy of trying to lose as little money as possible. So just stop doing that. Many people don't even realize that. They're just jumping in on trades that are good. They don't even look at the best, simplest, easiest to use indicator that would save them lots and lots of money. In fact, if you just avoid buying things that are too expensive, you will make almost as much as some people make, period, because they make these mistakes, extra over and above what you would make by picking good stocks in a core portfolio and trading with the 25%. We haven't gotten to there yet because I can't start talking about margin and leverage until I've at least given some basics on what we're doing so we don't get in too deep. If you don't know how to buy stocks in the first place, you certainly shouldn't be borrowing money or leveraging to do it. So somebody asked me about margin, and we will be talking about it. And one of the reasons that using margin the way I teach you how to approach the stock market makes perfect sense when it makes sense is because of our overall philosophy. The people that get in trouble using leverage and margin are trying to make as much as they can. They're borrowing money to buy some hot stock, hoping to make a lot of money. We're not doing that. We're using margin to make a little bit, a lot of the time, to enhance our returns. And because we're so extraordinarily careful in our whole life, not just in the stock market, of losing as little as possible and letting the market, letting the profits, letting the wealth come to us, we can use more margin than most people use in a safer manner to make even better returns than the people trying to make the most money they can possibly make. And that is really the beauty of what I'm trying to teach, is that it's some compilation of being really conservative and really careful, but also buying and owning stocks people don't think are conservative and careful, utilizing things like margin that people think is inherently dangerous and unsafe. We can do those things because of our overriding philosophy. It also, looking at my notes here, it will also give you the confidence when it doesn't work out. Not everything in life works out. That race car team that did everything right doesn't mean they're going to zoom off into first place for the whole race. So by looking at many different things on the way to the RSI and making your decision, you can get a couple of those things wrong and still come out ahead. You have the psychological backstop of knowing that you did everything you could. You're reanalyzing the trade, whether or not you want to go into it again with your second tranche of money, giving you the confidence to know that I did everything right. Odds are it'll work out in my favor eventually, just not today. and that's fine. Okay? So, I guess that's basically this video. Remember, life will give you whatever you demand from it. You want to try to lose as little as possible in every area of your life. Start with the big picture and narrow it down, and you won't end up buying stocks like the airline trade just because they're cheap. You'll buy it because all of those things make sense, because the RSI says it's a good time to buy. You put in your first tranche, not all your money at once, then you reassess. If it went down a little bit, sure, use that second tranche and get a little better price for that amount. If it falls off a cliff, you want to reassess, find out why. Why were you wrong? That's the thing with the second tranche. If it drops down, and by drop down, I mean 2 or 3 days of more than average declines that you didn't expect, you did something wrong. So running in with that second tranche of money would be a mistake until you find out what it is that went wrong, why, and is the stock worth buying, or now you have to wait for it to go even lower like you would have had to do in the airline trade. Okay? So the wealth that we're building comes from doing everything properly. That gives you a good feeling in life. Whether it's the stock market, once again, transfer it out. Doing things properly and well is its own reward. But in our case with the stock market, doing things properly and well, you can see how easy it is. You look at the big picture, narrow it down, RSI, all simple stuff. All we're doing is not making mistakes in life. And the money and the wealth will come naturally. I promise you. They say you only have to do 3 things to be middle class. Graduate high school, not get in trouble with the cops, not get a girlfriend pregnant out of wedlock. That's pretty simple stuff. But how many people mess that up? I've gotten a DUI in my life. I messed a little bit of that up along the way too. But in the stock market, it's the same thing. Being successful is being consistent and doing what you're supposed to do and avoiding these big bonehead mistakes. Like pretty much everybody that buys as the RSI goes up, if it goes up over the course of the next few days or a week, you watch and see. All those people would have been able to get much better prices if it pushes up to 73, 4, 5, 80, whatever, in just 2 weeks, because they're afraid to miss out on this market rally that we're having without realizing that they've missed the good part, the safe part, the smart part, where you lose as little as possible by getting in a few weeks ago. They're getting in now, and they're only going to get that part from 70 too expensive to 75 too expensive and hope they sell before it falls off a cliff. That is a losing strategy all the way around, not to mention it would be just against every rule I'm trying to teach you, but regardless of that, it just doesn't work. It doesn't work to switch from value to growth, from restaurants to hospitals, from hospitals to railroads, back to technology and this and that. That's another losing strategy. That's why we have 20% in cash, that eventually I'll teach you how to use that to switch around. But you don't need to switch around your main core portfolio just because some other sector is hot. Okay, and for those who might be concerned about the alpha portfolio, it's very common. People will go with these other sectors, sell some of their FANG, and it won't take any time at all where they realize that yes, they bought low, but it's still the restaurant, or it's still a business that's not as good as FANG. So their business went up, FANG went up like this. By the time they figure it out and it flattens out, FANG's right about the same place. They rush back into FANG, push it right up. Happens over and over and over, so don't worry about any of that. Let me check my notes here. Talked about fortune. Overbuying is the biggest problem in trying to recover from a mistake. It's a lot easier to recover from a $10,000 airline bad move than a $30,000 airline bad move. Okay? Overbuying, make yourself tranches of money. Now, as you get good, you may want to raise that first tranche up to 50% and have 225s. You're really bad, lower it to 10%, do a better job from the beginning, lower it down to 10%, raise the second one up to 50 because you're really good at the second buy. That becomes a personal thing down the road. Once you determine which buy you're best at, improve the one before it, lower it, raise up the one you're good at. Maybe it's the first one. You may be really good at doing it to where you raise that up. I would rather see You take that money you don't use and find another stock, especially if it's your first buy and you're good at it, because you'll probably be good at it with another stock too. I'd rather see you have two stocks going up from the bottom than one that you bought at the bottom and then you bought it up a little higher, even though it's a good stock. I'm not terribly against that, but I'd rather see you take